In this video, we are going to talk about the first part of this Excel sheet you see on the screen, with the ultimate goal of calculating decision measures. Things like net present value, internal rate of return, modified internal rate of return, profitability index, payback period, discounted payback period, and average accounting return. These here are blank tables that we're going to fill out over a few videos. In this video, we will concentrate on the pro forma income statement. Okay. Let's go ahead and zoom it in a little bit. What we have here is some information and data to use as inputs for the tables that we're going to build. Let's start with the pro forma income statement. We got year 0, year 1, year 2, and year 3. We are going to do, since they're pro forma, we're going to do the future. So we're going to be working on this area here. Now, keep in mind as we go, this is a simplified example. So some things are not going to reflect what reality looks like, but it's still the same process. So we start with our sales. Our sales pro forma or budget or prediction for year 1, that's going to be in form of dollars. And if they sell 50,000 cans of whatever product is in the can, and each can is $4, then it's as simple as multiplying the 50,000 cans times the $4. Now, in this example, we're not going to have sales growth over time. We're going to assume the same revenue for the next few years. So we can go ahead and just equal it in every year in that sense, since it's not growing sales. Variable cost. Well, if we have the amount of cans that are being sold and the variable cost, we can do the same thing where we take the total cans sold times the variable cost per can. We're also going to assume that the variable cost per can stays constant. So we're going to go ahead and put the same number over the years. Fixed cost. Well, fixed cost is very straightforward when you're doing total. We're not looking for fixed cost per unit. So it's just your total fixed cost there. Assuming that nothing changes over time and fixed costs stay the same, we will do the same there. Depreciation. Okay, so if we look at here, we're going to do the $90,000 of manufacturing equipment is going to be fully depreciated over 3 years. And since there is no detail or additional information, we will assume straight line depreciation. So we have fully depreciated over 3 years. The project life is 3 years. So we can take the 90,000 and divide it by the 3 years. And we get our 30,000 there. So what is our earnings before interest and taxes, which is our next item here? Well, we simply take the revenue minus the variable cost minus the fixed cost minus depreciation, and we have an EBIT of 27,570. Since every year is going to be the same, we can go ahead and do that. And that's why it's going to look the same there. Taxes is 21%. And we have that piece of information here, the tax rate. So if you take your EBIT, now I should mention this. The reason we're going from EBIT to taxes is because there's no information about any money borrowed. So there's no interest payment. So this is the same as saying EBIT minus 0 interest. And then we go to EBT, which is the taxable income, and then you take out the taxes. Because there's no interest, we can go straight to take away the taxes and then get the net income. So we take the taxable income in this case, because there's no interest, times the 21%, and we have that amount in taxes. To repeat, in this case, the EBIT and the EBT are the same because it's 0 interest. Okay, so given that every year is the same, we can just equal it every year. And then net income finally is just your taxable income minus taxes. And that will be the same for every year. And that is how you build your pro forma income statement with the information provided here. We will stop this video here, and on the next video, we'll talk about number 2, the capital requirements.